Let me ask you a question. What if you could grow your money without worrying about stock market crashes? What if you could access that money tax-free? And what if you could stay in control of your money without the restrictions of a 401k? That's exactly what we're going to talk about in this video. This video is about indexed universal life insurance, also known as an IUL, and more importantly, how a properly structured IUL actually works. What an IUL really is. An indexed universal life policy is a form of permanent life insurance. It has two main components. First, it provides a death benefit. Second, it builds cash value over time. Now, here's where people get confused. The cash value is not invested directly in the stock market. You're not buying stocks. You're not buying mutual funds. Instead, the growth of your cash value is linked to a market index like the S&P 500. Think of it this way. Your money is not on the field playing the game. It's sitting safely on the sidelines watching the scoreboard. How an IUL does not lose money. One of the biggest advantages of a properly structured IUL is something called a floor. Most IULs have a floor of 0%. What does that mean in plain English? It means if the market goes down, you not lose money. If the market drops 10%, 20%, even 30%, your account does not go backward. Now, when the market goes up, your policy gets credited interest based on that increase up to a cap. Once those gains are credited, they are locked in. Every year, the policy resets. So if the market goes down the following year, you don't lose what you already gained. And when the market goes back up, growth starts from that higher point. How indexing works without market risk. Here's another important point. Your money is not in the market. Insurance companies use very conservative strategies behind the scenes. They primarily use bonds for safety and options to capture upside. That's how they're able to give you growth potential without exposing your money to losses. So again, no stocks, no mutual funds, no market volatility directly affecting your account. Tax advantages and access. Now let's talk about taxes. Your cash value grows tax deferred, meaning you're not paying taxes every year as it grows. When structured properly, you can access that money tax-free through policy loans. There's no age 59.5 rule, no early withdrawal penalties, no required minimum distributions. Compare that to a 401k. With a 401k, your money is taxed when you take it out. You're penalized if you access it too early. And eventually, the government tells you when you must take money out. With an IUL, you control your money. Positive arbitrage and uninterrupted compounding. This strategy creates what's called positive arbitrage. You keep the gains, but you avoid the losses. And here's something most people have never heard before. When you take a policy loan from an IUL, your money continues to compound as if you never touched it. That's called uninterrupted compound interest. You're borrowing against your policy, not from it, so your money keeps growing. An indexed universal life policy is not for everyone, but when it's designed properly, it can be one of the most powerful financial tools available, offering safety, growth, tax advantages, and control. If this video was sent to you, contact the person who shared it and ask if an indexed universal life policy makes sense for your situation.